prospects for our economy. The Federal Reserve is one of the most important institutions in the country and indeed the world. Chair Yellen served as president of the San Francisco Fed, then as vice chair, then as chair of the Federal Reserve Board. Her distinguished service at the Fed encompassed the most tumultuous period in the United States financial and economic systems since the Great Depression. Many books have already been written about the events of this period, and many more will certainly be written from different points of view and with varying assessments. But one thing is certain: the financial system and the economy have stabilized. We are no longer debating how to reconstitute them, but rather how they might work even better. This hearing will review the developments since the crisis, and especially since Dr. Yellen became the chair of the Fed, in terms of the Fed's dual mandate of maximum employment and price stability. By the standard measure of unemployment, which is 4.1% at last reading, and by the standard measure of inflation, which most recently stood at 1.6%, both the first and the second goals have been achieved. Although the standard of metrics of unemployment and inflation are very good, all is not well in our economy. Economic growth has been slow, to the point that some economists have advised that we should try to lower our expectation for future growth by about a third from the average post-war growth rate. Wage growth has been surprisingly low, as has been business investment. Labor force participation has remained low, and various measures of economic dynamism, such as new business formation, are way down from before the previous recession. Various explanations have been offered, including an aging population and decreased international competitiveness of U.S. businesses that are impaired by taxes and regulation. But money and banking also seem to have a role. Commercial banks, rather than issuing more loans, are holding extraordinarily large amounts of reserves at the Fed, and the Fed has invested trillions of dollars in mortgage-backed securities and treasuries. So we have a condition of which businesses are investing less, workers are staying on the sidelines, and banks are lending less than they could. In short, the economy is not realizing its full potential. The Joint Economic Committee has devoted several hearings this year to determining why economic growth has been slow, and is interested to hear Chair Yellen's views. Taxes and regulation are major reasons for the reluctance of businesses to invest and hire more workers in the United States, which is why the current effort in Congress to reform the tax system is so very important. Both the House and the Senate versions of tax reform make critical improvements, in particular reducing the corporate tax rate to bring it more in line with those of other countries that we compete with. We are very interested to know how the Fed perceives such tax rate alignment, and whether its policymaking will assume that it increases the economy's productive potential. In closing, let me express my deepest appreciation for Chair Yellen's service to the nation in one of the most consequential positions for the economy and Americans' welfare. Chair Yellen, thank you so much. I will now yield to the ranking member, Senator Heinrich, for his statement.
Thank you, Chairman. And Chair Yellen, I want to begin by thanking you for your extraordinary public service. Your leadership at the Federal Reserve has played a key role in helping the economy recover from the financial crisis. The nation owes you a debt of gratitude for your careful stewardship of monetary policy. Last year, when you appeared before this committee, I asked you about how we can get the economy delivering for more Americans. Unfortunately, the economic situation is probably even more polarized today. Economic growth, jobs, startups, all are increasingly concentrated by zip code. And while we've made real progress since the recession, some parts of the country are still being left behind. Too many rural areas, too many tribal areas are struggling to get back to where they were a decade ago before the recession. I represent a state with an unemployment rate well above where it was when the recession began back in December of 2007. And that sure doesn't seem to me like we have fully recovered from this recession. I know that the Federal Open Market Committee has not yet made a decision on an interest rate hike next month, but if analysts are correct, the Fed is expected to raise interest rates, which would be the third rate hike this year, with many communities across New Mexico and the country still struggling I'm concerned that we may be putting the brakes on too soon. Wage growth remains weak, while health care, college, and child care are less affordable for working families. And this reality should inform both monetary and fiscal policy. We need targeted fiscal actions to grow the economy and to help these areas that have been left behind. But that's not what some of my colleagues are delivering in the current tax proposals. The Republican tax bill moving through the Senate adds $13 million to the ranks of the uninsured to pay for tax breaks for the wealthy and special interests. To hand out tax breaks to the wealthiest among us, Republicans are not only taking health insurance away from millions of Americans, but they are wasting an opportunity to invest in our people and our communities. There's a lot that we could be doing instead. Congress should be focusing on important goals such as growing the economy and driving up wages for working families. For the cost of the current tax proposals, we could literally provide all children with early learning opportunities, plus offer students free tuition at community colleges and public universities, ensure broadband access for every American, rebuild our infrastructure, and take bold actions to fight the opioid epidemic. But we're not going to be able to make those kinds of investments if Republicans insist on adding another $1.5 trillion to the debt for tax giveaways to the wealthy. Chair Yellen, as you conclude your term, it's an appropriate time to highlight the vital role an independent Fed plays in the economy. This Congress, as was the case in the last Congress, is considering several Republican proposals to limit the Fed's ability to independently conduct monetary policy. These bills seek to change the way the Fed carries out monetary policy, even going so far as requiring the central bank to swap its current mortgage-backed securities for Treasury bills. There are also proposals to limit the central bank's flexibility in responding to financial emergencies. This idea is especially hard to understand from my point of view in light of the critical role that the Fed played in responding to the financial crisis and preventing another Great Depression. I'm concerned about these attempts to undermine the Federal Reserve's independence, and I suspect you may be as well. I'd like to close with a point about the challenges of crafting monetary policy in today's political environment. Fiscal and monetary policies work best when they're aligned, but it's difficult to know with any certainty where Republicans in Congress are ultimately heading with fiscal policy. For years, they have pledged to reduce the deficit, but their tax package explodes the deficit. The disconnect between words and actions is also visible on infrastructure. President Trump has talked about the need to invest in infrastructure, but as we wait for a real infrastructure proposal for the administration, Republicans are proposing to eliminate key infrastructure funding sources, like private activity bonds. They said they would deliver middle-class tax cuts, but in 2027, nearly 24 million Americans earning less than $100,000 a year would face a tax increase under the current House Republican tax plan. And in the Senate bill, half of all households would see a tax increase when it is fully implemented. The chasm between words and policy must make the already challenging job of conducting monetary policy that much more difficult. Chair Yellen, again, thank you for your service to our country, and I look forward to hearing your testimony today.
Thank you, Senator. Rather than give the Republican response, I'm just going to introduce the chair. It is with great pleasure for me to introduce Dr. Janet Yellen, Chair of the Board of Governors of the Federal Reserve System. She has long experience at the Federal Reserve, including 4 years as the Vice Chair of the Board of Governors and 6 years as the President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. Chair Yellen previously served as Chair of the Council of Economic Advisors under President Clinton and as Chair of the Economic Policy Committee of the Organization for Economic Cooperation and Development. She's also Professor Emeritus at the University of California at Berkeley. Chair Yellen earned her PhD in economics from Yale University, has been granted an honorary doctorate of law degree from Brown University, and an honorary doctor of humane letters from the Bard College. Chair Yellen, welcome. You are recognized. Thank you.
Chairman Berry, Ranking Member Heinrich, and members of the committee, I appreciate the opportunity to testify before you today. I I will discuss the current economic outlook and monetary policy. The U.S. economy has strengthened further this year. Smoothing through the volatility caused by the recent hurricanes, job gains averaged about 170,000 per month from January through October, a somewhat slower pace than last year, but still above the range that we estimate will be consistent with absorbing new entrants to the labor force in coming years. With the job gains this year, 17 million more Americans are employed now than 8 years ago. Meanwhile, the unemployment rate, which stood at 4.1% in October, has fallen 0.6 percentage points since the turn of the year and is nearly 6 percentage points below its peak in 2010. In addition, the labor force participation rate has changed little on net in recent years, which is another indication of improving conditions in the labor market, given the downward pressure on the participation rate associated with an aging population. However, despite these labor market gains, wage growth has remained relatively modest. Unemployment rates for African Americans and Hispanics, which tend to be more sensitive to overall economic conditions than those for whites, have moved down on net over the past year and are now near levels last seen before the recession. That said, it remains the case that unemployment rates for these minority groups are noticeably higher than for the nation overall. Meanwhile, economic growth appears to have stepped up from its subdued pace early in the year. After having risen at an annual rate of just 1.25% in the first quarter, U.S. inflation-adjusted gross domestic product is currently estimated to have increased at a 3% pace in both the second and third quarters, despite the disruptions to economic activity in the third quarter caused by recent hurricanes. Moreover, the economic expansion is increasingly broad-based across sectors as well as across much of the global economy. I expect that with gradual adjustments in the stance of monetary policy, the economy will continue to expand and the job market will strengthen somewhat further, supporting faster growth in wages and incomes. Although asset valuations are high by historical standards, overall vulnerabilities in the financial sector appear moderate, as the banking system is well capitalized and broad measures of leverage and credit growth remain contained. Even with a step up in growth of economic activity and a stronger labor market, inflation has continued to run below the 2% rate that the Federal Open Market Committee judges most consistent with our congressional mandate to foster both maximum employment and price stability. Increases in gasoline prices in the aftermath of the hurricanes temporarily pushed up measures of overall consumer price inflation, but inflation for items other than food and energy has remained surprisingly subdued. The total price index for personal consumption expenditures increased 1.6% over the 12 months ending in September, while the core price index, which excludes energy and food prices, rose just 1.3% over the same period, about a half percentage point slower than a year earlier. In my view, the recent lower readings on inflation likely reflect transitory factors. As these transitory factors fade, I anticipate that inflation will stabilize around 2% over the medium term. However, it is also possible that this year's low inflation could reflect something more persistent. Indeed, inflation has been below the committee's 2% objective for most of the past 5 years. Against this backdrop, the FOMC has indicated that it intends to carefully monitor actual and expected progress toward our inflation goal. Although the economy and the jobs market are generally quite strong, real GDP growth has been disappointingly slow during this expansion relative to earlier decades. One key reason for this slowdown has been the retirement of the older members of the baby boom generation, and hence the slower growth of the labor force. Another key reason has been the unusually sluggish pace of productivity growth in recent years. To generate a sustained boost in economic growth without causing inflation that is too high, we will need to address those underlying causes. In this regard, the Congress might consider policies that encourage business investment and capital formation, improve the nation's infrastructure, raise the quality of our educational system, and support innovation and the adoption of new technologies. I will now turn to the implications of recent economic developments and the outlook for monetary policy. With ongoing strengthening in labor market conditions and an outlook for inflation to return to 2% over the next couple of years, the FOMC has continued to gradually reduce policy accommodation. The committee raised the target range for the federal funds rate by 1/4 percentage point at both our March and June meetings, with the range now standing at 1 to 1.25%. And in October, the committee began its balance sheet normalization program, which will gradually and predictably reduce our securities holdings. The committee set limits on the pace of balance sheet reduction. Those limits should guard against outsized moves in interest rates and other potential market strains. Indeed, there has been little, if any, market effect associated with the balance sheet runoff to date. We do not foresee a need to alter the balance sheet program, but as we said in June, we would be prepared to resume reinvestments if a material deterioration in the economic outlook were to warrant a sizable reduction in the federal funds rate. Changes to the target range for the federal funds rate will continue to be the committee's primary means of adjusting the stance of monetary policy. At our meeting earlier this month, we decided to maintain the existing target range for the federal funds rate. We continue to expect that gradual increases in the federal funds rate will be appropriate to sustain a healthy labor market and stabilize inflation around the FOMC's 2% objective. That expectation is based on the view that the current level of the federal funds rate remains somewhat below its neutral level. That is, the rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel. The neutral rate currently appears to be quite low by historical standards, implying that the federal funds rate would not have to rise much further to get to a neutral policy stance. If the neutral level rises somewhat over time, as most FOMC participants expect, additional gradual rate hikes would likely be appropriate over the next few years to sustain the economic expansion. Of course, policy is not on a preset course. The appropriate path for the federal funds rate will depend on the economic outlook as informed by incoming data. The committee has noted that it will carefully monitor actual and expected inflation developments relative to its symmetric inflation goal. More generally, in determining the timing and size of future interest rate adjustments, the committee will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. Thank you. I would be pleased to answer your questions.
Thank you so much, Chair Yellen. The Congressional Budget Office has noted that the United States Treasury is on track to lose corporate tax revenue over the next decade because of our high corporate tax rate and worldwide system are encouraging companies to shift income and even their own headquarters overseas. Could a lower corporate tax rate and a more competitive international treatment of our U.S. companies reverse this trend by making America a more attractive place to invest in?
So I think this is an important question for Congress to consider and to review all of the analysis that's been done on this topic. I would say there is widespread concern that the current structure of the corporate tax system does have the effects that you have indicated. But looking at the likely impact of particular proposals that may be under consideration is something that we haven't done carefully at the Federal Reserve, and I would leave it to members of Congress and the administration to judge what the likely consequences would be.
Okay, thank you. One other question. Major criticism in some quarters of Dodd-Frank has been the regulatory burden that it has placed on small banks in particular. There's a legislative initiative that would raise the $500 billion to $250 billion, the regulatory threshold for heightened oversight by the Federal Reserve. Do you agree that overly burdensome regulations has hindered particularly small bank lending to the effect of contributing to maybe the slowness of that economic recovery that we've both talked about from the last recession?
Well, I do agree that community banks face substantial burdens, regulatory burdens, and it's very appropriate for the Fed and other banking regulators to look for ways to reduce the compliance burdens that they face. We are I know we meet with many community bankers and are very aware of concerns about this. We are really focused on trying to tailor our supervision so that we find ways to reduce regulatory burdens. We have put into effect a number of changes that reduce reporting requirements, and recently have a simplified capital proposal that we think should address some of the concerns. But we have long been on record as favoring some increase in the $10 and $50 billion asset thresholds that are incorporated into Dodd-Frank. In particular, we think that the Volcker rule and incentive compensation are things that should not apply to smaller, less complex banks. And we do think an increase in those thresholds would assist us in appropriately tailoring our regulations. We do think it's important that the Fed retain authority to impose enhanced prudential standards on banking firms, particularly in the $100 to $250 billion total asset range, both for safety and soundness and financial stability concerns. And in particular, stress testing, we think is a particularly important component of our safety and soundness approach, and do think it's appropriate for that to apply to banks, let's say, over the $100 billion threshold.
Thank you. I'm going to turn it over to Ranking Member Heinrich for 5 minutes.
Thank you, Chairman. Chair Yellen, the unemployment rate in October was 4.1%, the lowest since late 2000. But that rate, that average rate, does not capture the health of the labor market in many areas in this country. You talked a little bit about that in terms of demographics as well. There is a broad expectation that the Fed could raise interest rates at its December meeting, and I'm certainly not asking you to tip your hand with regard to that. But what could change between now and the upcoming Fed meeting that could affect your thinking on that, either one way or the other? And then, if you would, talk a little bit about how you take into account those geographical and or demographic disparities in the labor market health when making those monetary policy decisions.
So I think it's a very desirable development that the unemployment rate has fallen to a level that's about the lowest we have seen since the early 2000s. And I do think that this is a development that has brought gains and improvements to almost all groups in the labor market. That said, there are huge disparities in how different groups are faring in the labor market, both in terms of unemployment rates, where, for example, African Americans traditionally and still have unemployment rates that are almost twice those of whites, but also across groups with different degrees of education and in different parts of the country. And I do think a generally strong labor market is helpful in alleviating all of those disparities, but we don't have a targeted set of tools that would enable us to address disturbing differentials across groups. More generally, labor market experience of different groups depends not only on employment opportunities and unemployment rates, but also on wages. And we have a multi-decade trend of increasing disparities in income and in wages, with the wage premium being earned by those with more education, that has continued to increase over time. And we've seen a long trend of disappearance of middle-income jobs that could be either automated or outsourced. So there remains a great deal of pain in the labor market, in spite of the fact that I think we've seen general improvements spilling over to all groups. You asked me about our upcoming meeting and our monetary policy decisions. So we are very focused. We have a dual mandate. We care about price stability, and we also care about employment and achieving our maximum employment mandate. At the present time, even though the unemployment rate is below levels that most of my colleagues see as sustainable in the longer run, inflation is running below our objective. And so our monetary policy has been designed to be accommodative and to allow the labor market to become tighter. We think that is actually helpful not only in its own right in bringing benefits to groups that are having a tough time in the labor market. And there I do see encouraging signs, for example, that in a very tight labor market where so many firms are having a tough time hiring workers, they're beginning to focus more on training. They're looking for ways to bring on board and help bring into their workforce individuals who in a looser labor market they would just put into the reject pile. So I think all of that's good, and we're not seeing undue inflationary pressure in the labor market, so our policy remains accommodative. But we do think it's important to gradually move our policy rate toward what I'll call a neutral level, which would be consistent with sustainably strong labor market conditions. And we want to do this gradually because if we allow the economy to overheat, we could be faced with a situation where we might have to rapidly raise rates and throw the economy into a recession. And we don't want to cause a boom-bust set of conditions in the economy. I would love to see a sustainably strong labor market, and we think if inflation is depressed on a temporary basis, as I believe, but we're carefully monitoring, we think that a gradual path toward a neutral stance is appropriate.
While we've been able to drive down unemployment in recent years, one of the things we haven't seen in that tightening labor market has been upward pressure on wages. Do you have an opinion on why that might be different today than in previous recoveries, and what policies would be important in trying to address that?
So it is true we have seen, I would just say, maybe modest upward pressure on wages. For example, the Employment Cost Index, which is a broad measure of compensation pressures, has moved up a little bit over it, and perhaps 0.5% or so over the last 3 or 4 years. But wage increases are modest. One lesson I take from that, or moral I draw, is that the labor market and the economy are not significantly overheated in spite of the fact that we have a very low unemployment rate. But importantly, over the long to medium term, the pace of real or inflation-adjusted wage growth hinges on productivity growth, that firms are really only able and willing to pay wage gains that are matched by productivity. And for reasons that are not well understood, productivity growth has really been dismally slow in recent years. And I do think, I mean, I can't tell you exactly what the reasons are for that. It may partly reflect slow technological innovation, at least as it spills over into producing measured output that's part of GDP. We're also seeing signs of less dynamism, the process of creative destruction of new firms, innovative firms, expanding at the expense of those that are less innovative. That process seems to have slowed, and I think some productivity growth is associated with that. But if you ask for what remedies can there be to this, and I think to really see a faster average pace of real wage growth, we need faster productivity. I would point you toward investments. Investments in people, investment in physical capital in the private sector, infrastructure investments can be helpful, and policies that facilitate innovation, and of course the education and human capital of the workforce. Those are the classes of policies that could have a favorable effect on these adverse trends.
Thank you. Vice Chairman Lee, you are recognized.
Thank you very much, Mr. Chairman. Thank you, Chair Yellen, for being here. I want to thank you for your service over the years. I've enjoyed the opportunity to visit with you as you've appeared before the Joint Economic Committee during your service as Chair of the Board of Governors.
Thank you.
We make policy here in Congress. Here in Washington, there are a lot of people who make policy. Policy is forward-looking. It requires us to look to the future, to anticipate events, and to set rules that will govern the behavior of members of our society. I assume you would agree with me if I said it's important when you're making policy from time to time to look back and review what you've done, figure out whether it succeeded or failed.
Absolutely.
And so retrospective reviews of policy can be a good thing. Now, does the Fed look back and review its monetary policy choices from time to time?
Our monetary policy
Yes.
choices, yes, of course we do.
And so in doing that, it looks back and tries to look at policy decisions it has made and figure out whether the data support those decisions. So if the Federal Reserve already does that, how would a congressionally mandated transparent review of those policy choices be a bad thing? Why wouldn't that be a good thing to have congressionally mandated transparent review of the Fed's monetary policy choices?
Well, we need to be accountable to Congress, and I completely agree that an independent central bank in a democratic society needs to explain itself to the public and to Congress, and appearances before Congress where you ask questions about our policy choices and how they worked out is 100% appropriate. Nevertheless, I do think that it is very important that the Federal Reserve, like most other central banks, be allowed to make independent policy decisions that are shielded from short-term political pressure. So you didn't mention any specific legislation or ways of accountability, but I've long expressed concern about, for example, audit the Fed legislation or more recently the Choice Act, because those acts would essentially bring short-term political pressure onto the Fed that could affect our monetary policy decisions by mandating real-time GAO policy reviews of recent decisions that would second-guess the decisions made by the Fed and call into question their legitimacy and credibility.
I understand that is your position, and at the same time, while we're talking about independence, the fact that these reviews are undertaken in the first place suggests to me that making them subject to a transparent review process would just allow the public to have input. I understand it's the desire, it's the impulse of any policymaker anywhere to insulate him or herself from any public review. But we do live in a republic where the people are the sovereigns, where ultimately the government is accountable to the people. And you at the Fed exercise a significant amount of government policy-making authority, and that's why I think these things are appropriate. My time is short. I want to get to a couple of other issues very quickly. The Joint Tax Committee's analysis of the tax plan pending before Congress is expected to assume an aggressive response by the Federal Reserve, one that would effectively assume that monetary policy would hinder some of the growth that could otherwise be anticipated from this tax reform policy. Now, you emphasized in your testimony today that you expect a gradual adjustment to monetary policy. And I would think that a gradual adjustment from the Fed would look very different and is certainly described very differently than an aggressive monetary policy. Do you agree those are two different things?
So what I would say is that we are very focused on our congressionally mandated objectives of employment and price stability, or 2% inflation. And we will try to adjust policy to achieve those goals in light of changes in the environment, whether they could be due to fiscal policy or, importantly, many other things that affect the outlook. I would say, look, we welcome strong growth. The Fed is not trying to stifle growth. We're worried about trends that could push inflation above our 2% objective. As I said, it's been extremely disappointing to the Fed, as it has been, I'm sure, to all of you and to the public, that we've achieved as much improvement as we have in the labor market in the context of growth that's been running only slightly under 2%. And if that pace of growth consistent with a labor market that's creating jobs for new entrants, if that rises, we will be delighted to support that and to accommodate it. So we don't have some cap on growth that we're trying to achieve, but in the context of an economy that's close to full employment, it would be growth to have sustained higher growth would require that changes boost productivity growth or growth in the labor force.
I understood. Understood. Last year, I asked you about how the Fed's approach to stress testing might damage the due process and property interests of investors, not just big investors, but also investors in the form of school teachers, firefighters, those who invest in any way and in any amount. Due process and property rights are undermined anytime you have a rule of law that is ever-changing, anytime you have a rule of law that it can't be understood as constant from one day to the next. It is so unclear, so opaque, or so subject to constant metamorphosis that one can't rely on what the law demands. What can you tell me about what the Fed has done since we last spoke to make sure that the due process rights of individuals, of investors, are protected?
So stress testing is a very important component of our supervision and has led to more rigorous, forward-looking assessments of capital adequacy at large banks and particularly those that are systemic. So this really is a key component of supervision. But I would agree with you that the firms that are subjected to it need to understand it. And we've done many things, including putting out for comment proposals concerning the design of our scenarios. We've put out a great deal of information about qualitatively what is in the models that we use. We've given feedback to firms on their models and comments on their submissions so they understand the shortcomings we see in their approaches. And we're currently working on a transparency initiative that would seek to provide more granular, more detailed information that would help banking organizations understand the ways in which specific characteristics of loan portfolios would affect our evaluation of stressed losses. So I would agree we would strongly resist publishing the actual models for a whole set of reasons, but providing more information so that banks understand how we're engaging in this evaluation is appropriate and important.
My time's expired. Thank you very much, Chair Yellen. Thank you, Mr. Chairman.
Thank you. Representative Delaney, you're recognized for 5 minutes.
Thank you, Mr. Chairman. And Chair Yellen, thank you for your incomparable service to our country.
Thank you.
I think many of us will miss you very much.
Thank you.
You gave a very nice overview of what's happening in the economy in general, on average, if you will, the macro statistics you opened up your presentation with, which describe a fairly stable to slightly positive picture in many ways. But I wonder, when do you think it's time for us to start thinking a little differently about the data that we look at? Because I saw some data recently where they disaggregated what's happened to two kind of portfolios of the population, the top 40% and the bottom 60%, and they track this since 1980. And when you look at that data, you see a very different picture. People in the top 40%, their incomes on average are up about 40% since 1980, and in the bottom 60%, they're flat. The top 40% on average used to be worth 6 times more than the bottom 60%. Now they're worth 10 times more than the bottom 60%. The top 40% used to spend twice as much on education for their children than the bottom 60%. Now they spend 4 times as much on education for their children. The retirement savings of the top 40% on a relative basis compared to what they'll need for retirement have actually improved since 1980, and the story is very bad for the people in the bottom 60%. Life expectancies back in 1980 for both of these groups were actually extending, and now for the first time in quite some time, we're actually seeing life expectancies of people in the bottom 60% going down. So I'm just wondering, when do you think we as policymakers, you in your position at the Federal Reserve and us as policymakers here on the Hill, have to actually start thinking differently about decisions we make based on the disparities that are starting to grow in our country? And I'm not talking top 1%, et cetera. I'm talking about large disaggregation pools, top 40% versus top 60%, because it seems to me that that bottom 60% is also particularly vulnerable to 2 macro trends that are going on. One, rapid change in the future of work based on automation and innovation. They're much more likely to have their jobs disrupted. And then further, they rely much more on important government programs that are likely to come under continued stress. So when you make decisions about what to do with monetary policy, how much have you started, or has the Fed started, to disaggregate some of this data and make the decisions differently?
Well, you describe in your question a set of very disturbing long-term trends that the Fed is very focused on, and in fact, some of the information that enables one to document these trends is produced by the Federal Reserve and our surveys of consumer finances and our surveys of household and economic decision-making. And of course, there has been over decades a trend toward rising inequality of both income and wealth in the United States, that it's not recent, it is something that has been going on for many decades.
Right, but does it cause you to change decisions you would have otherwise made based on what's happening for the average performance of the economy? Do you see what I mean?
Well, to the extent that the shifts in income distribution do affect the pace of overall spending in the economy. For example, if high-income households spend less of extra income they earn than lower-income households, that shift in income distribution can make a difference to overall spending, and it is something we would take account of.
Because I would think, hearing your average statistics, that the position to actually continue towards a more normal rate environment makes sense, but when you look at this disaggregated statistics, I would at least be really scared of how vulnerable this bottom 60% is to any kind of shock in the economy. And I guess moving on to what we should be doing, I mean, in your judgment, when we think about fiscal policy, tax policy decisions, spending policy decisions, how much should we really have a laser-like focus on programs, whether they be investing in infrastructure, investing in human capital, creating incentives in the tax code for people to allocate capital to parts of the country that have been left behind economically? How high a priority should that be for us in making our decisions based on the statistics that you're looking at?
So for us, unfortunately, we don't have tools that enable us to target particular groups. So our own focus is, well, we take these trends and study them. We really only have a blunt tool that can't address this, but Congress and the administration, you have a much wider set of tools, and obviously it's up to you to formulate appropriate
Would you
priorities.
consider it urgent for us to be addressing these trends?
Well, I am very disturbed and have spoken out for many years about the disturbing trend toward rising inequality. And the equity of the tax code is something that I think should importantly be taken into account. And as I said earlier, we're suffering from slow productivity growth. And here, too, I think it's quite important that in making fiscal policy and other decisions, that the focus be on how can that be improved? And that does point to investment in people, infrastructure, also private capital, technology, education. So these are squarely, I think, in Congress's court, and I do think they're urgent to address.
Thank you again, Chair Yellen.
Representative Schweikert, you're recognized for 5 minutes.
Thank you, Mr. Chairman. And look, this may be one of those auspicious days. I don't know if this is probably your last time to come and do this. It's also our chairman's probably last one. I'm going to miss Mr. T. Berry because he's one of the few people to tolerate me, so I appreciate. Last thing in this sort of love fest, it's an opportunity to say something publicly that I've said to the chairwoman privately. Your team around you, particularly your senior team, has always been very kind to my staff and myself, particularly when we've had some more unusual data type questions. I'm still a bit of a advocate of one day more and more of the models becoming public, but a lot of that is already beginning. I mean, I live on some of the Atlanta Fed's data, their GDP now, and they allow you to look at parts of the formula. So I believe that openness that you began with has come a long ways. It would be wonderful one day to be able to log in and do certain stresses. For those of us in the policy making, what would happen if labor force did this? What would happen if interest rates did this? And sort of understand what's in sort of the back end of some of the data.
So, Congressman, you know, the model that we use at the Fed for economic analysis of overall economic trends, we refer to it as FRBUS, Federal Reserve Board /US. This model is in the public domain. It's sitting on our website, and people anybody who wants to perform a what-if exercise, what if monetary policy were different, or if the labor force grew faster or slower. We have tried to provide access to that tool
and
to
it's
the
gotten
public.
so much better. I mean, I live on the Atlanta Fed's app. I know that's a snapshot of current time, and snapshot is not a trend, but it's been very helpful in removing some of the mystery. Now, to run through a dozen questions as quickly as I can, and you actually touched on this. I had the experience of flying back to Phoenix about a week ago, and I was looking at something that was a few years old, and then the current unemployment, and was looking at the tables of labor force participation and what was being predicted a few years ago of what would happen and what we see happening right now. And it was talking about the demographic trend. The labor force participation is going to continue to fall, but yet we see some really interesting thing in the last 3 quarters of folks that were being predicted not to be moving into the labor force are moving into the labor force. We just saw some recalculations of numbers of Social Security disability. And all of a sudden, the longevity of the trust fund jumped substantially because it turns out a number of folks who are in labor, Social Security disability moved back into the labor force. So there's something in our models that, and I know it's at the margin, but we're already seeing some of the data that this substantial economic opportunity that's in the labor job opportunities is actually starting to pull people we thought were falling out of labor force participation. If you had an interest in that, where would you go to find more information in such a thing? This sort of goes back to Senator Lee's question of the ability to back test and sort of figure out where we've also made mistakes in some of our models.
So, I mean, Fed researchers have done very detailed modeling of labor force participation trends, and that's published research in places like Brookings Papers and referee journals, and my staff could provide you references on that. As I mentioned in my opening statement, what we've seen over the last 3 years is aggregate labor force participation has been essentially flat. The trend is downward, and a flat labor force participation with a downward underlying demographic trend means just what you said.
Was contrary to what we were predicting just 4 years ago.
Well, I think a strong labor market does attract people back in, and people who might have left and retired are being incented to remain in the labor force. Of course, we know that more recent cohorts of retirees, although when people reach retirement age, their labor force participation falls significantly. Younger retirees are working more than older retirees, and that's a trend.
And that's a really interesting trend of how many of our seniors are staying in the labor force.
More than they used to.
And I know I know I'm going over time, but oh, he just left, so I was going to compliment. I fear often we fuss at the Fed, but you only have so many tools, and a lot of the tools are actually sitting here with us, and where some of us may both absolutely agree and disagree ideologically. There was some interesting thing in we'll call them the crosstabs in the data of trade school type jobs, a lineman, to use a previous conversation, and seeing salary movements in there. But yet we often turn around and reinforce a university education model, and it turns out it may be our own misallocation of design and resources that are actually causing many of these problems out there, that we have to rethink what we're doing policy-wise. And with that, yield back, Mr. Chairman.
Thank you. Good comments. Representative Maloney, you're recognized for 5 minutes.
Thank you, Mr. Chairman. I just want to start out by thanking Chair Yellen for your extraordinary service. As the very first woman to lead the Federal Reserve, you broke a major barrier, and we are so very proud of you.
Thank you so much.
And thank you, too, for your record as Fed Chair. I think your record speaks for itself. The unemployment rate has fallen to 4.1%, the lowest in 17 years. Inflation has been steady. GDP growth is now a robust 3%. The Fed also ended the quantitative easing program, has begun the process of shrinking the $4.4 trillion balance sheet, and has started to gradually raise interest rates as the economy improves. So in short, I would say your tenure has been an unqualified success by every metric. You have been one of the most successful Fed chairs in history.
Thank
so
you.
I just want to publicly thank you for your service, everything that you've done, and say that I and many of us in this nation will miss you.
Thank you so much. I appreciate that.
I want to ask you about regulation. I think that the Fed has generally done a good job under your leadership in writing regulations that have strengthened the safety and soundness of our financial institutions. But there have been discussions in Congress right now about tailoring these regulations that were put in place after the financial crisis. And as you know, the Senate Chairman Crapo has introduced bipartisan legislation on regulatory relief, a major package for banks. Some people want to go further than this and really roll back Dodd-Frank. So I have two questions. First, do you think it is a good idea to roll back Dodd-Frank in this post-crisis regulatory time? And secondly, what do you think of Chairman Crapo's regulatory relief package? Do you think it goes too far, or do you think it strikes the right balance?
Well, let me start with the first question about rolling back Dodd-Frank. I think that Dodd-Frank provided an excellent roadmap to a series of changes that have led to a far safer and sounder banking system, and one that has been able, over the last 10 years, there have been stresses of all sorts that have hit the U.S. financial system, sometimes emanating from abroad, and it's proven resilient and able to support good growth in a strong labor market. And core reforms include more and higher quality capital, more liquidity, stress testing, which I think is very important, and resolution planning. So if a systemic firm were to fail, that we would have the tools to be able to deal with it without its imposing such costs on the economy. And I would not want to see those things rolled back. I think it would be very dangerous to do so. That said, do believe it's appropriate to tailor regulations to the systemic footprint of a financial institution. And so tailoring is an important principle. And we've long indicated that we would be supportive of raising some of the thresholds incorporated into Dodd-Frank, in particular the $10 billion and $250 billion thresholds. And that would give us more ability to tailor to the systemic footprint of particular firms. Particularly important to us is having the continued ability to impose enhanced prudential standards on a firm that might fall under a new threshold if we thought it was justified by safety and soundness or financial stability concerns. So the legislation that's been proposed, I haven't had a chance to study every detail of it, but I would say it generally incorporates those principles and is a move in a direction that we think would be good in enabling us to appropriately tailor our supervision.
Thank you. And also the U.S. banking system is the strongest in the world. But we now have international standards that have raised the capital requirements for all banks. And I know that you're having ongoing discussions about capital standards at the international level. Are you considering lowering the international capital standards at all in these discussions?
You know, we've had a global agreement to raise capital standards, Basel III, and what's under discussion now are some details about particularly contentious issue is the use of internal models as opposed to standardized capital requirements. And the foreign firms, particularly European firms, some of whom rely on internal models, testing and analysis suggests that they may hold too little capital relative to what we think would be appropriate based on what U.S. banks have in standardized models. So we have ongoing discussions of this issue, and I think are coming closer to reaching agreement on this final issue, which would enable us to finalize Basel III. So this is really not a question about changing standards for U.S. banks. It's more about the standards that we would want to see applied to foreign banks. But we chose to impose standards on U.S. banks, particularly systemically important banks that exceed the global minimums that were agreed in Basel. Those are expected to be and intended to be minimum requirements in individual countries that see a need and benefit from having higher standards are fully expected to adopt higher standards, and in some cases, particularly with the largest and most systemically important U.S.-based banking organizations, we've done that in imposing higher standards and think it's appropriate and warranted by the safety and soundness benefits for our financial system.
Thank you. The gentlelady's time has expired. Mr. Paulson is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chair Yellen, let me also thank you for your service to the country and taking the time to engage with us as policymakers. You mentioned earlier about the importance of having more robust growth and dynamism that is needed in the economy in terms of investments in capital, investments in people, employees at different companies, and certainly some of the tax policies that we're engaged in and talking about right now will and can and should lead to that, I think, more robust growth that I think a lot of people would anticipate. I just want to dive a little bit more into some of the conversation we had earlier about, you mentioned wage growth has been relatively modest, and you've got this Phillips curve issue, right, which the Fed looks at certainly in terms of the logic of it. When you have a tight labor market, you should have, with low unemployment, that should lead to more competition for workers, then you're going to have higher wages, and some of those higher wages would get passed on down to higher prices for consumers, right? So inflation would rise. But the data doesn't really sort of support that, right? It's been sort of this mystery. And so I'm just curious from your perspective, as you look right now at whether the so-called Phillips curve that depicts this inverse relationship between unemployment and inflation no longer being valid. I mean, what are your thoughts around that?
So it is still a framework that I personally find useful. I think the relationship between unemployment and inflation has become more attenuated over time, and so the impact of changing unemployment on inflation has diminished, and I think that's well documented in many studies, so I don't want to overstate just how strong that linkage is, but the overall framework incorporates an understanding that there are other very important factors that affect inflation. And when you look at the U.S. inflation history over the last 5 years or since the financial crisis, movements in oil prices and also movements in the dollar that have translated into significant changes in the pace of inflation of imported goods, those things have had very substantial effects on overall U.S. inflation. So if we look back, say, over the last 3, 4 years, 5 years, I don't think it's a mystery why inflation has been so low. First, we had a lot of slack in the labor market. Then we had periods when we had falling oil prices that really pulled inflation down. Starting in mid-2014, the dollar appreciated substantially. That held import prices down. It really wasn't a mystery. And we want inflation to be close to our 2% objective as possible. But of course, there's going to be variation, and these things produce variation. What is surprising is this year. This year, with a 4% unemployment rate, we're in the vicinity of full employment. Oil prices have been roughly stable, and the dollar, if anything, this year has depreciated somewhat, pushing up import prices. So why has inflation fallen this year and been so low? That's puzzling, and I've opined on the fact that there may be a number of transitory or idiosyncratic factors that explain that, but it's something we're keeping an eye on and want to look carefully at. But I would say generally a framework that incorporates the labor market, slack in the labor market, along with these other factors, does provide a pretty good understanding of inflation in the U.S.
And would you say that some of the tax reform proposals that have been talked about, and it could be the corporate side for large employers, but also for small employers, that are aimed at increasing productivity, even with a low unemployment rate right now, would be helpful or essential in terms of making sure that those individuals in that age 25 to 54 range that have, in their prime working years, where you have a higher labor force participation rate, for instance, would that higher productivity help change and enter those people into the labor market again?
Well, I think investment spending by private companies does matter to how well equipped members of the labor force are to produce, and stronger investment could raise productivity, and if productivity growth goes up, that can serve to boost wages. But the linkages between tax policy and investment spending are ones that economists don't agree on, and it's important, I think, for Congress to be trying to evaluate what you think the likely impact would be. But stronger investment, I think, would have those favorable impacts.
Thank you.
Thank you. Representative Beyer, you're recognized for 5 minutes.
Thank you, Mr. Chairman, very much. I want to add my thanks, too, for your firm hand, your deeply grounded wisdom, your nonpartisan leadership, and you've fulfilled the dual mission of the Fed.
Thank you.
Low unemployment, stable, low inflation, very, very well. So we're really going to miss you.
Thank you, Congressman. I appreciate that.
You know, the candidate Trump talked about abandoning NAFTA, and now the Trump administration's working on prioritizing modernizing NAFTA with Mr. Lighthizer. And yet we've seen that the higher perception of NAFTA risk is driving down the value of the peso, is making Mexican goods and services more competitive. Do you agree that stable trade treaties are still the best way to solve trade imbalances?
So without commenting on the details of NAFTA or any particular trade treaty, I generally think that at least overall the United States has benefited from a more open global trading environment. We've gotten the benefit of a broader range of goods and services available to consumers at better prices, lower input costs for firms, and the ability to export to a broader range of markets. But there are adverse impacts of such developments on particular groups in the labor force, and it's important for Congress to keep in mind the need to address dislocations that may come from trade, but generally I think it's been beneficial. And from Mexico's point of view, the studies that have been done suggest, the U.S., I think, enjoyed some benefits, at least overall, from NAFTA. Mexico, I believe, enjoyed significant benefits, and as you have said, there has been downward pressure on the peso because of what the discussions that are taking place.
Yeah, thank you. In the Washington Post, there's lots of discussion now about how much dynamic growth will occur from the current tax cut packages that are out there. The Washington Post has suggested, the editorial board, that if the revenue increase targets are missed, that taxes should be restored or automatically raised. Is this the best way of ensuring fiscal responsibility?
Well, I will say my understanding is the the idea of triggers is motivated by a concern that some have over the picture we have of debt sustainability now and into the future. And I would simply say that I am very worried about the sustainability of the U.S. debt trajectory. Our current debt to GDP ratio of about 75% is not frightening, but it's also not low. But when you look at, for example, CBO's long-term budget projections, it's the type of thing that should keep people awake at night. And it shows a picture in which, as our population ages, expenditures on Medicare, Medicaid, and Social Security grow more rapidly than tax revenues, and the debt to GDP ratio moves up. And this should be a very significant concern. So exactly what is the right way to address this, I think, is a matter for you to decide. My understanding is the trigger discussion is motivated by that, and I just say it's right to be focused on that problem, and I would urge you to remain focused on it.
And you're absolutely right. That's what stimulates the trigger discussion. Yeah. And Mr. Paulson talked about the Phillips curve, and you talked about low oil prices, the movement in the dollar, with transitory idiosyncratic factors and our low inflation. Others have suggested that technological innovation, the global disinflationary impulse of integrating China, all these other low-cost countries into our global trading system, does it mean that the FOMC 2% target is going to be hard to hit for the foreseeable future?
Well, we are forecasting that inflation will move up over the next year or two back to 2%, and I think that's a reasonable forecast, although I believe there is uncertainty about it, which is why we've indicated we're closely monitoring these trends. But as important as the trends are that you described, I mean, they are important trends, and I would point out that our estimates of the sustainable level of the unemployment rate have declined very substantially, and the factors that you discussed that have arguably exposed firms more heavily to global competition, constraining prices, and restrained bargaining power of labor, rather than necessarily showing up as chronic low inflation, these things can instead mean the labor market can operate on a sustainable basis at lower unemployment rates than we might have thought of in the past in the 60s or 70s or 80s. Currently, my colleagues estimate the sustainable level of the unemployment rate in the U.S. at just over 4.5%. That contrasts with a 6 or higher we used to think. And I think the trends you mentioned have been influential in meaning, yes, in other words, yes, it's true, it takes a tighter labor market or lower unemployment to give us 2% inflation. So I don't mean to minimize their importance, but I think it should be achievable for us, and we do have a low unemployment rate.
Thank you very much. Mr. Chair,
thank you. Representative LaHood is recognized for 5 minutes.
Thank you, Chairman Berry, and thank you, Chair Yellen, for your service to the Federal Reserve and to our country.
Thank you.
I had a question as it related to the commercial mortgage market. And we're all aware in 2008, 2009, when we had the financial crisis as it related to the housing mortgage market. And as we look at the growth of Amazon and other online retailers across the country, really changing the business model as it relates to retailers. And we continue to see traditional brick and mortar stores and malls and others being really obliterated across the country. JCPenney's, Macy's, Sears Roebuck, and large malls. And in a lot of medium-sized markets, there continues to be vacant commercial properties, and these type of brick and mortars become more and more unproductive. And as we look at the commercial mortgage market, I wonder if you could comment on whether there is a possibility, as these unproductive properties continue this trend of causing a financial crisis like we saw in 2008 and these markets going bad.
So I think you're raising an important question. I don't have detailed information at my fingertips on these trends. I think that delinquency rates are generally remain pretty low in commercial real estate. There are legacy properties incorporated in CMBS that have much higher delinquency rates, but we're focused on underwriting standards at banks, at maintaining strong underwriting standards to protect the banking system against possible weaknesses that could result in especially commercial real estate. We're seeing overall in commercial real estate that valuations are very high, and we've highlighted elevated asset prices. Commercial real estate generally is an area also where we do see elevated prices or low cap rates. So we are focused on soundness of underwriting standards and the safety and soundness of banks associated with it. But in detail, just how this trend is going to play out, I'd like to get back to you on that.
And as you sit here today, do you have any fears or concerns?
Well, these are obviously significant trends that are affecting retail. What they will mean for banks is something I'd like to look at more closely and get back to you.
Okay, thank you. Another topic, I wanted to just talk just generally about the makeup of the Federal Reserve. For the last decade, the Federal Reserve has had at least one vacancy in the board of directors, and should Mr. Powell become the next chair after your resignation, the Federal Reserve Board will only have 3 out of 7 positions filled. I understand that the President must nominate and the Senate must approve each of these appointees, and that both parties are culprits in the gridlock there. Can you give us examples of how the Federal Reserve does not function optimally or efficiently without a full board of governors?
Well, I do think it's important that the number of governors serving on the board increase, and ideally it would be at full strength at 7. Certainly my colleagues and I would welcome additional appointments to the board. And in fact, I don't think there has been any significant amount of time, perhaps not ever, that the board has operated with only 3 members. That is a very rare and difficult situation. But let me say, it does not stop the Federal Reserve from carrying out its mandated activities. And while our deliberations benefit from having more individuals with a range of views and, of course, extra pairs of hands to help manage the various operational and oversight responsibilities that we have, the Fed is able to carry out its key work even with a diminished board.
And just lastly, do you have any suggestions on reform as it relates to this topic?
To reform as it relates to the Federal Reserve in general? Or?
Yeah, recommendations or reform measures to help with this problem of only having 3 or limited members on the board.
Well, I think it's part of the trend of slower appointments and more vacancies, and I think it's really, it creates a problem for it to take so long to have individuals nominated and confirmed. And this is, something I think it's important for the Senate to look at, and the administration. There have been many reports, including one I participated in myself some years ago by the National Academy of Sciences about vacancies and the difficulty of making appointments to agencies. So I do believe it's a significant concern, but I don't have suggestions for you on how to improve that.
I agree with you on that. Thank you.
Representative Adams, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and let me add my words of thanks along with my colleagues, and certainly I want to associate myself with the Congresswoman who made the comments about the accomplishments you've made as a woman. And hopefully we can find some women as smart as you to fill some of those seats. But thank you very much for your service.
Thank you.
In my home state of North Carolina, the unemployment rate in the first quarter of 2017 was 4.2%. For African Americans, it was 7.5%. For Hispanics, 5.3%. This unemployment disparity is not a recent or one-time occurrence. The Economic Policy Institute looked at the change in unemployment rates between 2007 and 2017. And their analysis shows that the white unemployment rate in North Carolina is now below what it was before the recession. And while the unemployment rate for African Americans and Hispanics is actually higher than it was before the recession. So do you believe that the Federal Reserve should ever consider its full employment mandate achieved when there is significant disparity between the white unemployment rate and the black unemployment rate?
So I find the disparities, which have been there for many years between African American white and Hispanic and white unemployment rates, to be very disturbing and to reflect broader problems that minorities and less skilled individuals also are having in the labor market, and they're very worrisome and damaging trends. But I would say that for most of these groups, unemployment rates and other measures of labor market functioning are back to levels that we had pre-crisis. So I believe it's the case that since the Bureau of Labor Statistics started collecting information on African American unemployment rates, that it almost never declined below 7%. These rates bounce around a lot. In September, the African American unemployment rate did decline to 7%. In the most recent reading in October, it moved up about 0.5%, but it is generally at a low level. So unfortunately, African American and other minority unemployment rates and labor market experience are highly cyclic. So when the Great Recession hit and unemployment nationally skyrocketed, the worst experience, the largest increase in unemployment and the greatest toll came for African American, Hispanic, and other minority workers. As the labor market strengthened, actually the African American unemployment rate has declined more strongly than that for whites. And the disparities now, which are long-standing, African American unemployment rates are basically double those of whites. We're back to something like that again.
Thank you very much. The United States makes up about 5% of the world's population, 21% of the world's prisoners. In 2014, African Americans constitute 2.3 million, or 34% of the total 6.8 million correctional populations. What do you think is the impact of mass incarceration on unemployment, racial disparities?
Well, I think it has a very important and negative effect, and there have been many discussions about ways to potentially address that, but clearly it's something that employers will be less willing to hire individuals who have criminal records, and this is a serious problem and concern. I will say that, and this is anecdotal as opposed to systematic, but as the labor market has tightened and so many firms now, almost all firms we talk to, report they're having difficulty finding workers, I do hear more reports of individuals who may have a criminal record who are succeeding in finding jobs and being integrated back into the labor force, but is clearly a very significant issue.
Thank you very much, and you actually answered the other question I was going to ask in your response about the labor force and getting back into it. So thank you very much.
Senator
I yield back.
Senator Peters, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and once again, thank you for your service. I appreciate your leadership on this committee and wish you well in all of your future endeavors. And Chair Yellen, I'll add my accolades to everybody else on the committee. We appreciate your tenure as chair. You have presided over the Fed during some very challenging times and have always been a very steady hand, and we appreciate that steady hand and look forward to following you in your future endeavors as well, which I'm sure will be equally as significant. So
Thank you so much. I appreciate that.
So, Chair Yellen, in response to some previous questions, you mentioned, and I'd like you to maybe elaborate a little bit, that the linkage between tax policy and investment is under some dispute among economists, that there is disagreement as to whether or not a tax cut would definitely lead to a level of investment. Is that because the data is inconclusive? I mean, tell me a little bit more about this debate and why we can't necessarily think that there is that strong linkage.
So I'm not an expert in this topic. Let me say that at the outset, and it's not one that we're attempting ourselves to independently evaluate, but there is a literature on this. I think empirically the linkages are not clear, so it's difficult based on empirical information to draw strong conclusions. Theoretically, tax changes that lower the cost of capital ought to, in principle, incent greater investment, and with greater investment there is arguably some pass-through into wages. But I would say empirically, just generally, impacts of the cost of capital on investment spending are very hard to detect also in economic data. And while most economists think there is some linkage, it isn't strong enough or pronounced enough to come across in a clear way in the economic data. And then, of course, the entire set of tax changes that are under consideration matter. So I think this is a complicated question.
Well, it is complicated, and it's because it depends on the investment decisions that are made by people who receive these tax breaks, and those are human beings. So my experience has always been it's probably best just to listen to folks as to what they would do if they get a large tax break. In fact, I think it was interesting that today in Bloomberg there's an article, Trump's tax promises undercut by CEO plans to reward investors. So CEOs are telling us something very different than what we're hearing from the administration. In fact, they're telling us that for most part, if they get this tax break, they're going to do share buybacks. They're probably going to be significant share buybacks. Robert Broadway, chief executive of Amgen, said that earnings call that he's been actively returning capital, and he's going to continue to do that in the form of dividends and buybacks. Executives from Coca-Cola, from Pfizer, Cisco's CFO, Mr. Kramer, said, quote, we'll be able to get much more aggressive on share buyback after a tax cut. At a November 14 speech to the Wall Street Journal, CEO counseled by Trump's top economic advisor, Gary Cohn, the moderator asked business leaders in the audience to show hands if they had planned to reinvest these tax proceeds. Few people responded. I think a couple hands went up. Another provision, according to this article, that would impose an even lower tax rate on companies stockpiled overseas earnings, giving them an incentive to return trillions of dollars in offshore cash to the U.S., that money is also unlikely to spur hiring because companies are already well capitalized and can bring on as many employees as they need, according to John Shin, who's a foreign exchange strategist at Bank of America Merrill Lynch. In fact, I think he's quoted as saying, companies are sitting on a large amount of cash. They're not financially constrained. Shin, who conducted a survey of more than 300 companies asking their plans for a tax overhaul, and they said they're all basically focused on their shareholders and engaging in buybacks. So as the Fed looks at this, and they're saying that there's not a linkage between these tax cuts and investment, in fact, CEOs are saying they're going to do share buybacks. As the Fed is looking at that in your policies, Are share buybacks generally, are they going to increase wages?
Well, I don't think share buybacks would increase wages. The usual linkage would be investment in capital and equipment would, if they occurred or to the extent that they occur, would help raise the productivity of the labor force, and in boosting their productivity would likely end up raising wages, but the linkage occurs through capital spending and not through share buybacks.
Yeah, share buybacks don't do anything. And in fact, share buybacks will increase the stock price. That's really the main reason for that. So if you have stock options, well, you're going to do really well. If you're a significant shareholder, you're going to do really well. But the person on the floor of the shop making the products, they're not going to see much of anything unless they own some shares and their mutual funds perhaps, which would be great. But it's disproportionately at the very top. So an efficient way of growing an economy is not to be engaged in share buybacks. And I would argue, and just your thoughts, and we've talked about the fact that there's less dynamism in the economy as well. And there's certainly a number of economists believe that part of that lack of dynamism is a result of an increasing concentration of capital in fewer and fewer firms.
That is true.
So that is accurate. That because of that concentration, we're seeing fewer firms, less dynamism, less business formation. Also, that can slow growth. When you have that kind of concentration, growth is constrained. So if you're a company and you want to increase your share price, probably the best thing to do is just to do a share buyback. And boy, if you get a tax windfall, that's going to be great. And how is that going to impact your policy?
The gentleman's time has expired, but the chair may finish answering the question.
So we will, understand there's uncertainty about what the impact of policy will be, and as it unfolds, it will, and we see what those consequences are. We'll try to evaluate it as it occurs, but there's tremendous uncertainty, as I said, based on existing literature.
Right. Thank you so much, madam.
Thank you, Senator. Senator Cruz, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chair Yellen, welcome. Thank you for your service. Thank you for your testimony today.
Thank you, Senator.
You noted in your testimony that inflation has continued to run below the 2% rate that the FOMC considers the most consistent with maintaining maximum employment and price stability. And you've expressed some uncertainty as to why this is the case. One factor that your testimony didn't discuss is that our labor force participation rate remains at its lowest rate since 1978 at 62.8%. How does the historically low labor force participation rate impact your assessment of the employment picture that the country is facing right now?
Of the employment picture?
Yeah.
So it's a complicated question because there are good reasons why labor force participation in the aggregate is declining in the United States, and it's a trend we expect to continue because it mainly reflects the aging of the U.S. population and the fact that individuals, once they reach their retirement years, participate much less in the labor force than before those years. So even though more recent cohorts of retirees are working more than their parents did, overall the labor force participation rate drops when the population ages. So this is a continuing trend. It's not going to go away. However,
so if I might though, what about discouraged workers and workers who drop out of the labor force who are working age, who are not seniors but simply giving up on hopes of finding meaningful employment?
Well, if you look at prime age workers, their labor force participation rates have come up as the economy has expanded. They're not quite back to the levels we saw pre-recession. But what you do have in the United States is for prime-age workers, especially men, chronic, long-lasting, multi-decades decline in labor force participation. And my own assessment would be, so that's not about retirement, that's about working age individuals who are not participating in the labor force. I think that reflects longer term trends that are adverse, that are affecting particularly low-skilled Americans in the workforce, the disappearance of middle income jobs, pressures on wages at the lower end, the opioid crisis, which partly reflects that labor market distress, but also contributes to individuals staying out of the labor market and being not able or willing to work. So I think we do have adverse trends affecting labor force participation. I mean, when you ask me how does it impact my view of employment, well, when I see for the last 3 years U.S. labor force participation rate has been essentially stable, I see that as a good trend showing improvement in the labor market, because stability is occurring in the face of what is a declining underlying trend. And so it does suggest that with a stronger labor market, we've got individuals who are being drawn back in by greater job opportunities and more help-wanted signs that they're seeing.
I agree with you. The trend, particularly towards working-age adults dropping out of labor force, is troublesome, and we need serious economic policy to address and hopefully change that trajectory. One of the factors that I think is important for doing so is a robust small business sector, and an ongoing concern is credit availability for small business. When Congress passed Dodd-Frank, one of the major bases for Dodd-Frank was stopping the phenomenon of too big to fail. I think as we've seen Dodd-Frank implemented, the big banks are all bigger now. You made reference to that in your last answer, that we've seen an aggregation of capital. The giant banks have gotten bigger and bigger and bigger under Dodd-Frank, and we've seen small financial institutions, community financial institutions, going out of business at a record rate. How would you assess the effectiveness of Dodd-Frank, in particular on impacting small and community banks, and how is that impacting credit availability in turn for small businesses?
So, as you point out correctly, community banks are gradually diminishing in numbers. It's been a very tough environment for them, and we do recognize that regulatory burden is something that they're suffering from, and it's something we're very focused on trying to address and reduce. So I think that for us is and should be a very important priority. I mean, there are other things that are making it tough to be a community bank, including the fact that we're in a low interest rate environment with a pretty flat yield curve, and that's impacted net interest margins and earnings. So that's a completely separate factor. But in terms of small business lending, the landscape has changed a lot. Perhaps community banks are providing less than they used to. Large banks are providing more. Online lenders and new fintech firms are coming in and filling part of the void and devising new ways to lend quickly to small businesses in ways that are perhaps less costly than traditional banks. But our surveys suggest there are some particularly small and minority firms that do feel that they don't have adequate access to credit. Surveys of small firms like the National Federation of Independent Business, that is somewhat larger but still small firms, suggest that most firms feel they have adequate access to credit. They don't feel they're in an environment where their credit needs aren't being satisfied. So as a general matter, I think credit is available. I think banks are looking to extend credit when they when we ask them regular questions, they tell us they don't see much demand on the part of small businesses for credit. It's sometimes hard to disentangle demand, what's driving something, whether it's demand or supply, but there's evidence that there's weak demand, and it's not simply a matter of weak supply due to regulations.
Thank you, gentlemen. Gentlemen, time has expired. Thank you. Last but not least, Senator Klobuchar is recognized for 5 minutes.
Well, thank you very much. Thank you, Mr. Chairman, and thank you for your service and good luck. Thank you, Senator Heinrich, and thank you, Chair Yellen. I sent out a tweet about you, about how you've been a strong, trusted, steady presence.
Thank you.
You've done good work, and it's very popular. So always when someone retires, you know, it's like a good moment. But mostly I want to thank you coming in as vice chair and chair at difficult times in our country. And certainly in my state, I've seen your steady hand and what we've seen with the unemployment rate in our state's at 3.3%. While I see issues with the cost of things, I see issues with our debt, other things that we have to tackle in the Congress, I do want to thank you for that steady hand.
Thank you so much. I appreciate that.
So one of the things that I've talked about in the past, I don't think it's been talked about too much here, is just the infrastructure issue. And I'm so disappointed as we look at this tax bill that we're seeing both in the House and now in the Senate, in that it adds, in the Senate's case, over $1.5 trillion in debt, but we didn't put any money into infrastructure, which if we're going to start messing around like that, I would think we would want to really put in an injection of funding into our infrastructure. Could you talk about how improving U.S. infrastructure, including our broadband, can benefit our economy?
Well, I do think it's one of the factors that impacts productivity. And when I think about what we can do to improve living standards and raise productivity, I think about all sorts of investment. So private investment in capital equipment is important. That affects many workers. But
you and I talked about the depreciation tax, how important that was during the downturn, the depreciation allowance.
But, I mean, infrastructure is important. And then I would also add to that focus on investment in people and human capital, which is, and especially in light of rising inequality, is a form of investment, too, that deserves emphasis.
Right, and that has been a major focus of mine, some because our state has such a low unemployment rate, especially in our rural areas. Susan Collins and I introduced a bill to expand apprenticeships program, and I think there's much more work we could do. Could you talk about that issue, is that we've got students that sometimes aren't graduating from high school or are graduating from even college with degrees, and then they can't find jobs, and yet we have hundreds of thousands of these jobs that are in welding and trade and these things, and how we
So, I mean,
get at
there
that.
clearly is, we have a tight labor market. Almost every firm that you talk to discusses the challenges of finding qualified workers, and there is a degree of mismatch that the qualifications that people have, sometimes college graduates, but often high school graduates, can't qualify for the jobs. So I think training, apprenticeships, other countries like Germany seem to do a better job of matching people with jobs and training firm than we do. I've made a practice of my own when I travel around the country. I'm interested in what sort of programs work. There are a lot of efforts by community colleges and nonprofits, sometimes partnering up with firms to try to address that skill gap. And what I would say is I've seen many programs I think are very promising in in 6 months or a year, giving people the training and credentials they need, maybe for a manufacturing job that requires technical skills, doesn't require a college education. And what I'm particularly gratified by is that in a tight labor market like we have now, firms are really interested in these programs, and they really want to participate because they really need workers. And when they care about it and they don't have a lot of applications in the hopper, they're willing to invest in it too and partner with the community college or the nonprofits and guarantee that somebody coming, they participate in these training programs. And they'll guarantee that when someone comes out successfully of the program, they're going to at least be sure they're going to get a chance at a job at that firm. And this is occurring, so this is an area that obviously Congress can consider investments, but this is private sector
Exactly, and I think it's just making it easier with everything from if tax credits or if it is also just pilot programs, best practices, those kinds of things. I was just at Summit Academy in Minneapolis, which is focused on minority students. 700 a year are getting these credentials, and they directly go into the jobs when they graduate because the companies like Thor Construction, one of the biggest minority-owned construction companies that just worked on our stadium that's going to host the Super Bowl, not that I'm doing hawking up here on stage, Mr. Chairman, in February. But it was just really, I think these things have to be encouraged because otherwise we're going to lose work if we don't have these.
I completely agree, and I think it really is, these programs are deserving of emphasis and can be very successful. We're trying through our own work, our community development programs that exist in the reserve banks to understand what's best practice in this area and to disseminate information about approaches that work.
Thank you very much. Thank you. And I look forward to seeing you in your new capacity, whatever
Thank you
it is.
so much.
Thank you.
Appreciate it, Senator.
Thank you, and I echo the comments of your tenure and your service to our country. And this being your last hearing, it's been an honor and privilege to get to hear you. And like you, this is my last hearing at the Joint Economic Committee as the chairman. And I want to thank Ranking Member Heinrich and Senator Lee and all the members of this committee for making my term a successful one. I also want to particularly thank the hardworking staff at the Joint Economic Committee. And in particular, I want to thank Whitney Daffner, who's helped lead the committee, who's sitting to my back. And for the historical knowledge, I want to thank Colleen Healy for helping us kind of get through all the challenges at the beginning of this process. So it's really been an honor and a privilege to chair this hearing. I look forward to watching it in the future as a private citizen. And again, thank you, Chair, for your distinguished service. Should members wish to submit questions for the record, the hearing record will be open for 5 business days. With that, we are adjourned.
Thank you so much.
Thank you.